Coming to you live from the world headquarters right here in Houston, Texas of Concenture Wealth Management. Hope everyone's doing great. Here in Houston, as everyone knows, we're starting to get a little bit of rain and it feels really, really good not to have days of 100+ degree temperatures. Just fingers crossed we don't get one of those big tropical storms to come into town. Hey, I just wanted to touch base with everyone. Hope you're doing well. Hope everything's going great as we get here into football season and kids going back to school and things start to cool off a little bit. Just wanted to kind of touch base on what's going on in the markets. You know, if you go back and you look starting in June, about mid-June, we had the markets basically touch bottom and start to have this fantastic run. That lasted all the way until just, I don't know, a couple weeks ago, mid-August or so. At that point, after we got done with earnings and earnings season and everything coming out, we started to hear a lot more about what was happening in the economy, the Federal Reserve. You started to have different Federal Reserve board members coming out and kind of talking a little bit hawkishly about the economy and about inflation. All that was kind of brought to a massive crescendo at the last week of the Jackson Hole meeting for the Federal Reserve, where they came out and Chairman Powell, who spoke for 8 minutes, basically said, this is not over. Inflation's still our concern. People need to be prepared for some pain. Well, this is what we have to expect. Number one, the Federal Reserve's been very, very clear. They're going to continue to raise interest rates. So we have to make sure that we're prepared. If you go back and look in history, we had this period in 1966 to 1982 where the markets, for all intents and purposes, did nothing. In 1979, Paul Volcker became chairman of the Federal Reserve, and he started to viciously attack inflation by utilizing interest rates and raise interest rates significantly. And after the markets in 1981, you had inflation at double digit. You had him come and raise interest rates, the Federal Reserve, that is, raise interest rates to over 20%. That caused the economy to go into a recession. That caused unemployment to jump up to 11%. And then after all of that pain and all those excesses were worked through the system, the markets started to kind of go and move forward. And we started this great run from 1982 to 2002. Now, I'm not suggesting that we're in a period like the late 70s or even the early 70s for that matter. There are a lot of differences. Some of the things that I go through and I think about right now, we have more than twice as many jobs available as we do people who are available to go to work them. What does that mean? That means that wages are going to move up, which, by the way, isn't necessarily a bad thing, but it clearly is inflationary. The reason why it's not a bad thing is because we've gone so long without having any sort of wage growth in this economy. We also have some deflationary pressures. That is, technology continues to drive the price of manufacturing, continues to drive the price of goods and services down. It's those raw materials that continue to go to drive it up. So what are we doing? What do we think we need to be aware of? Number one, we have to make sure we have the ability to be flexible. We have to be able to make adjustments in portfolios, and pulling back on our risk makes a tremendous amount of sense. We need to make sure that we have money available when it needs to be available. We need to pick and choose our times. As we look forward, what do I think is going to happen? Well, I think in the next month, this month of September, all the way till maybe mid-October, we're going to end up with headlines driving this market. A lot of attention is going to be focused on what the Federal Reserve is saying and the economic numbers. Once we get through September, all eyes are going to be on paying attention to what's happening with companies' earnings and the election. My take is that the election, as it looks right now, is going to end up at the very least with the divided government, with the House of Representatives going to the Republicans, and a toss-up about what happens with the Senate. What that means, Wall Street loves this, is that there will be gridlock. Nothing can happen in Washington. There'll be gridlock. I think that should be what lifts us through. I also expect that sometime here, September, October timeframe, the Federal Reserve is going to say, okay, I think we're good. Don't be surprised towards the end of the year and into the first quarter of next year to start to see energy costs start to go up, because that's when the release of the strategic petroleum reserves cuts off at the end of August. The bottom line is there's a lot of headwinds, but there's also some good things in the market. Companies' earnings and valuations companies' earnings are relatively good, and valuations of those companies have come down, so they're much more reasonably priced. As long as we are being strategic with our investments, we're going to have success. That means managing the amount of risk and managing it towards your risk and making sure that we get the outcomes that we're after. Just wanted to quickly touch base. Hope everyone's doing well. Know that we're always here. I know that there are a lot of questions that you may have. Reach out to us. We're going to be proactively reaching out to you. I hope you have a great month. We'll talk to you here real soon. Have a good one.